As the gray eminences of the Federal Reserve gather this week for their bimonthly conclave, a deluge of economic data awaits them, a torrent of numbers that could upend their carefully cultivated projections or provide a merciful affirmation of their prescient policies. The stakes are high, for the path they chart will reverberate through every crevice of the American economy, shaping the fortunes of borrowers and lenders, investors and spenders alike. At the eye of this statistical maelstrom looms the all-important May reading of the Consumer Price Index, that great arbiter of inflationary pressures, set to be unveiled mere hours before the Fed's own prognostications are to be made public. This numeric harbinger could prove the pivotal determinant, recalibrating the central bank's anticipated trajectory of interest rate reductions for the year. The inflation numbers will be the ultimate determinant, proclaims Diane Swank, chief economist at the venerable firm of KPMG, her voice carrying the gravitas of one who has weathered many such tempests. You are going to get inflation data during the meeting, and that is what is going to determine the dots. Ah, yes, the dots, those inscrutable coordinates on the Fed's hallowed chart, each one representing the anonymous individual projection of a committee member, collectively coalescing into a median forecast that shall guide the nation's monetary course. But as the economic winds have shifted since their last tabulation in March, a downgrade in the number of envisioned rate cuts seems all but inevitable. Yet the Fed's chair, the indomitable Jerome Powell, has decreed that such ephemeral data should be embraced even at this late hour. In a past press conference, he declared, FOMC participants are encouraged to update their projections when key data are released during the two-day policy meetings. An 11th-hour revision, then, is not merely permissible, but actively promoted, a nod to the ever-evolving nature of economic reality. And what might this forthcoming data deluge portend? A plurality of seasoned economists foresees the median projection coalescing around 2 rate cuts in 2024. While an equal portion envisions just one reduction or none at all, a testament to the divergent interpretations of the selfsame evidence. Some officials may even raise their estimates of appropriate long-term rate levels, reflecting a growing sense that the traditional tools of monetary policy have lost some of their potency in constraining economic forces. They do see some upside risks, cautions Derek Tang of the consultancy LH Meyer/Monetary Policy Analytics. His words carrying a judicious note of circumspection. That means easing very carefully, making sure that they're not over-easing and inadvertently boosting the economy. For even as the Fed strives to choreograph a soft economic landing, a misstep could upend the delicate equilibrium, potentially stoking inflationary fires or inducing an undue contraction. The challenges are myriad, the consequences profound. Inflation itself, that specter that has haunted the nation's conscience for the past 2 years, seems poised to receive an upward revision in the committee's projections, a reflection of the obstinately elevated readings witnessed in the first quarter. The unemployment rate, too, having edged up to 4% in May according to Friday's report, could see its forecast adjusted higher, a potential harbinger of economic headwinds. Yet amidst this swirling sea of data and projections, the Fed's public posture seems set to remain largely unchanged, at least for now. The committee is widely expected to hold its benchmark rate steady for the 7th consecutive meeting, retaining the guidance that no reductions shall be entertained until a sustainable downturn in inflation can be confirmed. In its statement last month, the Fed acknowledged a lack of further progress on taming inflationary pressures, a characterization that could take on a hawkish tinge should it persist in light of April's moderation in price growth. Every utterance, every nuance, shall be parsed and dissected by the legions of economic oracles seeking to divine the Fed's true intentions. And into this crucible of analysis and anticipation strides Chair Powell, the immovable object confronting the irresistible force of economic upheaval. He shall be pressed on the median projections, interrogated on the prospect of rate cuts in the coming months, and doubtless queried on the implications of the imminent inflation data. For while the Fed may officially track a separate gauge of consumer expenditures, the Consumer Price Index looms as an inescapable bellwether, its implications impossible to ignore. Powell must also contend with inquiries regarding the softening labor market and the fading economic momentum, twin specters that could portend a looming retrenchment. People might ask him about the softening momentum and how they think about it, posits Stephanie Roth of Wolf Research, her voice tinged with curiosity. He is likely to say they are monitoring it, and so far the consumer seems to be okay, maybe some cracks from the low end, but this is something that they're keeping a close eye on. And so the stage is set for a high-stakes economic drama, a narrative woven from the threads of data and divination, projection and policy. As the Fed convenes amidst this swirling vortex of numerological portents, the nation watches with bated breath, for the decisions rendered shall echo through every stratum of the American experience, shaping the financial fortunes of millions. In this crucible of economic statecraft, each data point carries seismic implications, every projection the potential to uplift or undermine. The Fed's soothsayers must navigate these treacherous waters with preternatural precision, lest a misstep capsize the nation's economic vessel. It is a grave responsibility, a Herculean task, yet one they have sworn to undertake with unwavering resolve. For in this era of profound economic uncertainty, where the currents of inflation and employment, growth and recession swirl in an ever-shifting kaleidoscope, the Fed stands as an indispensable bulwark, its policies the levees protecting the American household from the surging tides of financial turmoil. This week's gathering, then, is far more than a mere convocation of economists. It is a pivotal juncture, a potential inflection point upon which the nation's fortunes could turn. Let the data deluge commence. The Fed's prognosticators stand ready, awaiting the numerical omens that could seal their collective fate. The American economy watches with bated breath, hopeful that from this cacophony of statistics, a harmonious economic melody may yet emerge.